Hi everybody. In the previous example, we calculated from tops-down approach. We calculated total operating income variance was $22,000, and we calculated that $6,000 of that was because of sales quantity, and $16,000 was because of flexible spending variance. And we also calculated that the total operating income, the difference between the two, is 22,000, and hence these numbers were adding up. In the previous example, we also calculated that the assumption was the SG&A variance was 0. We calculated that out of the 16, sales price variance was $1,000 and manufacturing cost variance was $15,000. Now we are going to take a closer look at the $15,000 and see how that is distributed between direct material, direct labor, and manufacturing overhead. So let's start with direct material. Direct material budget units is $10,000. Labor budget is another $10,000. Our budgeted variable manufacturing overhead was $20,000, and now we have the actuals. The direct material comes in $1,000 higher. Direct labor is $2,000 higher compared to budget, and actual variable manufacturing overhead is also $2,000 higher. So, what is the direct material variance? What is the direct labor variance? And what is the manufacturing overhead variance? Direct material variance is the difference between these two, the actual minus the material budget, $1,000 unfavorable. Direct labor variance is the actual direct labor minus the budget, $2,000. And manufacturing overhead variance in this case is the difference again between the actual and the budget, $2,000. Now let's go back and rewrite our numbers. We know that this is 1,000, this is the difference. The direct labor cost variance is 2,000. Variable manufacturing overhead, we calculated that is 2,000 as well. In order for them to add up, fixed manufacturing overhead budget variance needs to be $10,000. Is that the case? If you look at the actual fixed cost minus the budgeted fixed cost, yes, the difference is $10,000. Now we have a better picture of understanding, okay, there was a $22,000 difference. Why is that? $6,000 because of sales quantity, $16,000 because of flexible spending. Out of that $16,000, $15,000 is because of cost variance, $1,000 because of sales price. We assumed no SG&A variance. And then we further dive into $15,000, and $1,000 was because of direct material cost, $2,000 was direct labor cost, and $2,000 was variable manufacturing overhead. The rest, $10,000, was fixed manufacturing overhead budget variance. Now we are going to continue looking further down and try to understand out of the $1,000 direct material variance, how much is it the price variance, how much is it usage or efficiency variance. We will do the same for direct labor, and we will do the same for variable overhead as well.